a common man as such. These are the average retail prices of essential items. I haven't picked them up from the market. These prices have been taken from the economic survey. As the government of Pakistan presents the various price levels of various products, and I've also given the increase from last year, which is the last column, which you will see that how the increase has been there in various essential items. And these are some of the essential items which I have picked up, which includes mutton, beef, chicken, and milk, sugar, and the similar items. And if you see the major increase, which is increase in almost everything, but the major increase which has come up is about 45% in the sugar pricing. This is again very, very important. Public debt. What has happened? All that has resulted into basically when we've had higher inflation, we've had very little investment situation coming into the market, lowest saving rate and lowest investment rate. Naturally, the public debt has gone up. And if you see, it has gone up in foreign currency term as well as in local currency term. I'll briefly talk about it a little later. This is but to show you that we have about, at the moment, about 56% of GDP as the debt. And why I have picked up that particular chart for you, it's not that bad if all other things in the economy are supporting it. If you see India, the public debt is 80% of GDP. It is 80% of GDP if you look at this chart, which is there. And India, in overall context of three Asias, when people talk of emerging economies and talk of Asia, they talk of three Asias. Three Asias mean that China and India on the one side, then all those countries which are dependent on their domestic markets, a number of countries, and the third is the one which are trade-dependent countries like Singapore, like Hong Kong, like Taiwan. These are trade-dependent countries. So they talk of the three Asias. These are the three Asias which are there. And in terms of that, the forecast is that the way China and India are growing, in about next 5 years, there could be a situation where India may even surpass the growth which is being experienced by China. And there are a number of factors. I'm not going into that detail, but I'm highlighting. They still have 80% of their public debt as 80% of GDP, but they can sustain it, support it, because the other things in the economy are doing differently. There's a high level of growth which they're maintaining for period to period. And basically, then there is an institutional strength which is there, which has come up. The infrastructure investments are being made. They still have a lot of issues. They still have a lot of problems. But this situation will show you how is it. The social sector thing, and I think one important thing in this, although a number of things are there, but I'll take you to the per capita income thing if you look at that. If you see the per capita income, which has come up to over $1,000, basically, at this stage, the India's per capita income is $1,119 as per their last budget. So we are almost at the same level. But interesting thing is that the forecasts which are being done for next 10 years, the figures are very, very different in the two contexts. Pakistan's thing is only coming to somewhere around 1,400 in 10 years, and the India is going up 3,400 or 3,500 in those 10 years. That's the estimate of the World Bank and the other global agencies, that this is the way the two economies will move forward in this situation. This is the exchange rate situation, exchange reserves. This is basically subsidies. The important thing to note is that what we have done, that we have brought down the subsidies basically substantially. This is, I'm just showing you, and I'm sure I won't be able to take you through this particular chart. This is the BMI ratings. And these BMI ratings are very important. Business Monitor International rates various countries in terms of political, economical and business environment situation. And if you see that in terms of the countries which are picked up, our short-term political rating is 16, which is 41.3, whereas the emerging market average is 63.4. 100 is the best, 0 is the weakest. That's the way they work it out. And the long-term political situation is basically improving, but it is going up to 53.4 and coming nearer to the average, which is 58. Our short-term economy rating is 44.6, which is as average is 50. And similarly, long-term economy has improved when the position of political economy, this position is improving. The economic situation is improving. And in the long term, we see it to 40.8, basically, which is still lower than the average, but coming nearer to it. And the business environment situation is 36.7 as against 41.4. And I've got given there the areas why business environment is a problem: the investors' protection, the rule of law, the contract enforceability, the corruption, the trade rating, the protectionism, and the bureaucracy. All these are the various factors which comes in terms of the business environment evaluation, and I've given you ratings in all those contexts. This is the rolling target situation which we have. We have a rolling target for a medium-term business forecast which has come up, and those medium-term budgetary forecasts which is given by the government of Pakistan is that we'll grow from 4.1 to 4.5%, and 2012-13 will grow to 5.5%. Let me tell you that in contrast to that, the forecasts which are made by Business Monitor International and the World Bank basically is that we'll remain up to 2015 somewhere around 3.3 to 3.5% a growth GDP situation. Our inflation is going to be around 10% or little more, rather than the figures which are given here. Let me talk about the outlook and conclude. Outlook is basically in front of you. The security woes are the problem. They remain a major drag on GDP. The cost of this in the last 5 years has been $43 billion. $43 billion has gone on this particular aspect, which is the security situation of the country. And that has been a major cost which has gone into. The consumption has been the primary growth catalyst rather than the development or investment. It is not development or investment which has been bringing up the growth. The consumption has been bringing the growth. And the growth has been limited by low investment spending which we have. We have fiscal overspend to continue, so the fiscal deficits are going to continue. We have basically defense and debt servicing. These two together takes 80% of your tax revenue. Revenue growth has been disappointing. Persistent inflation reduces the possibility of the rate cut. So you've seen that after the initial 2 cuts which was done by the central bank, we're maintaining the level of the base rate at 12.5, and that's been continued. And there's looks very little chance of further cut in those rates. And CPI effectively is to drift lower short-term cost push pressure to limit medium-term CPI downwards. And the reason is pretty clear that on the one hand, the inflation will have a pressure on it. On the other hand, the energy situation, which has costed us almost 2 to 2.5% of GDP this year, that will have a problem. Irony is, ladies and gentlemen, that we have a drag of 2 and 2.5% of GDP due to this particular energy sector, and in the actual allocation for power sector, where in the peak situation we have got a shortage of 5,000 megawatt. Basically, that is the shortage. Our allocation is 0.2% of GDP. We have allocated only 0.2% of GDP for the power sector. And that is, and I don't see that how within this particular allocation we are going to address the issue of the power sector problem. Banking sector expansion naturally is currently being affected by economic